For more on the Fed, the banks, and everything else, we want to bring in Sarah Bloom Raskin, who served as a Fed governor and deputy Treasury secretary during the Obama administration. She's now a law professor at Duke University and a CNBC contributor. And Sarah, thanks for being here. Let's just talk about what's happening, how these things are playing out right now. Crisis of confidence. What can and what should the Fed do?
So, well, you're exactly right. We are still seeing elevated levels of bank stress, and we see this through the balance sheet that the Fed actually releases periodically and released on Wednesday. And as you just indicated, we are seeing elevated levels of borrowing. Borrowing really from two facilities, from the traditional discount window, which has been in place since really the founding of the Fed, and is a very important piece of central banking. It's the lender of last resort function. That's the discount window. And since the financial turmoil resulting from Silicon Valley Bank and Signature Bank, you have this new facility that has been established called the Bank Term Lending Program. And if you put the amounts that have been borrowed from those two facilities in the last week, you'll see that those amounts are indeed elevated. Now, whether this elevation means something pernicious or something calming is being debated. You can see the facilities being used. So some investors, depositors, stakeholders will feel essentially okay. It's being used. That's a good thing. They're there. They're providing support. On the other hand, there are other people who say, wait a minute, these levels are so much higher than they traditionally have been in periods of non-turmoil that there still must be significant stress and that this is concerning. So you see really elevated uses of these facilities. The facilities, one of which was put in place, the evening of March 12th, early March 13th. And so these are, this is still with us. The bank stresses are still with us.
Yeah, I guess the big question is ensuring deposit. I think that's been, one of the big questions in the hot potatoes. The authorities don't have the same, Fed and Treasury don't have the same toolkit that they had for the last financial crisis because of changes legislatively that would prohibit them from doing some things like that. Do they have enough tools to handle this and to shore up confidence?
I think they do. The tools are really quite vast, and you can turn the faucets up really high. So I would argue that not all the tools that were used during the financial crisis have been used right now, but the tools that have been used now are really quite forceful, and you can see that they're being used. So these emergency lending facilities, they become used at times of systemic crisis. Systemic crisis was the designated reason why these tools are now available by law in the U.S. A systemic risk was named after Silicon Valley Bank and Signature Bank experienced their massive outflows.
We were just talking with Larry McDonald. I know you heard that conversation. His point was maybe the ECB is not going to want to have raised 50 basis points, nor the Fed 25 basis points heading into this, kind of pointed back to what happened to Trichet at the ECB back in 2007.
Yeah, there's definitely a relationship between the ability of a bank to respond to increased interest rates and that path of interest rates. So as any central bank changes the interest rate environment, banks need to adapt. And one of the things that we are now seeing here is that the Fed actually moved ahead on a very aggressive path of interest rate increases, which it was, required to do pursuant to its inflation focus. But at the same time it did that, it may not have been particularly cognizant of the stresses in the system, which had to do with the ability of banks to manage their interest rate risk. And that is looking to be very much the linkage between interest rate risk management and a Fed funds rate increase.
So what happened with the oversight from the Fed? Was it just not stringent enough? You hear about the stress tests that took place just last year that didn't really even stress for something very obvious like climbing interest rates, rapidly climbing interest rates.
Yeah. So there's going to be a lot of focus on this. Some lapses having to do with regulation, some having to do with supervision, and some maybe having to do with a different kind of culture of what oversight actually means. But one thing that is certain is that there is this there was a movement of the Fed funds rate that proceeded on the monetary policy side without the sufficient comfort that all banks were going to be able to handle it from an interest rate risk management perspective. So, ideally, you kind of do a bed check, before you engage in an aggressive change in your interest rates at the Fed.
To make sure there's no bed bugs.
To make sure there's no bed bugs. And guess what? In this case, there were. So we are now seeing this linkage, the Fed, I think, is appreciating this linkage a little bit more.